Most high-income earners spend their career doing the right things financially. They save consistently, they contribute to their 401ks, they invest regularly, and they live below their means. On paper, it looks like everything should fall right into place once retirement begins. But many high earners are surprised to discover something unexpected, that even with a 7-figure portfolio, they may feel restricted when deciding how much income they can comfortably withdraw each year. Not because they lack the assets, but because taxes, Medicare premiums, Social Security rules, and required withdrawals can all interact in a way that limits how much spendable income they have. This isn't about poor planning or bad investment decisions. It's about how the retirement income system is structured for higher earners. Today, I'm going to walk you through what I call the retirement income ceiling, which is a point where taking more income may lead to higher taxes, higher Medicare premiums, and reduced long-term flexibility. This concept doesn't apply to everyone, but many high earners encounter these constraints without realizing what's causing them. Hi, I'm Tracy Schaff, Certified Financial Planner at Sterling Shire Investments. If you're in your 50s or your 60s and you're already thinking about how much income you'd like to generate in retirement, feel free to book a meeting with me using the link below. Now, let's break down why high earners often feel a ceiling on their retirement income and what may help create more flexibility. Part 1. What is the retirement income ceiling? The retirement income ceiling isn't a literal limit. It's the point where withdrawing more money from savings triggers additional financial consequences. For example, certain withdrawals may increase taxable income, and higher income can shift a household into different Medicare premium brackets. Social Security benefits may become partially taxable, or investment income may stack on top of required minimum distributions, otherwise known as RMDs. Or a higher marginal tax rate may apply to apportion withdrawals, or other benefits may be reduced or taxed differently. These impacts are not guaranteed for all retirees, but they are common for households with substantial savings in pre-tax accounts or multiple income sources. For many high-income retirees, this income ceiling often appears between approximately $120,000 and $180,000 per year in total household income, though it varies based on location, filing status, account types, and tax law. The important point is that crossing certain income thresholds can have ripple effects. Understanding those ripple effects can help retirees avoid surprises later. Part 2. What creates the income ceiling? There are 4 key financial triggers. High earners often have multiple sources of income in retirement, and these sources all interact with the tax system in ways that may create limitations. Here are the 4 most common triggers. Trigger number 1. Taxes can rise quickly for higher income retirees. Many high earners assume their tax brackets will drop in retirement, but depending on how their income is structured, that's not always the case. Some retirees draw income from pre-tax accounts like 401ks and IRAs, taxable brokerage accounts, Social Security benefits, pensions, or deferred compensation, RMDs beginning at age 73, and dividends and capital gains. Because pre-tax withdrawals are fully taxable, they can push retirees into higher marginal tax rates, particularly when combined with other income sources. This doesn't mean taxes will definitely increase, but retirees who rely heavily on pre-tax savings may find themselves in higher brackets than expected, which can limit how much income they choose to take. Trigger number 2. Medicare IRMAA brackets affect higher earners more easily. Medicare premiums are income dependent. If your income exceeds certain thresholds, premium for Medicare Part B and Part D may increase. The higher the premiums, called IRMAA adjustments, apply even if income spike is temporary. Importantly, Medicare looks at income from 2 years prior. Even a one-time withdrawal or Roth conversion may affect premiums. And higher income households may cross these thresholds earlier. This isn't a penalty, it's simply how the system is structured, but it can limit how comfortable retirees feel taking higher withdrawals. Trigger number 3. Required minimum distributions can increase taxable income. Retirees with significant savings inside pre-tax accounts can face larger required minimum distributions beginning at age 73 under current law. Even if a retiree doesn't need the income, the IRS requires these distributions, and they can increase the taxable income, increase the taxation of Social Security, they can increase the Medicare premiums if income rises above certain thresholds, and it increased the marginal rate on other income sources. RMDs don't automatically create a problem, but they can contribute to the income ceiling for retirees who want to maintain a stable tax bracket. Trigger number 4. Social Security can become taxed based on household income. Social Security benefits are based on a combined income, which includes half of Social Security benefits, all other taxable income, and some tax-exempt interest. If combined income crosses certain thresholds, up to 85% of Social Security benefits may become taxable. This is not a penalty, it's simply part of the Social Security formula, but it means increasing withdrawals from savings, which may lead to larger portion of benefits being taxed. Part 3. Why high earners often feel caught in the middle. High earners tend to feel this ceiling more than others for 2 reasons. The first is that they have substantial balances in their pre-tax accounts. This means that a large portion of their retirement income may be taxable. And then the second, their desired lifestyle often requires a higher level of income. More spending may require more withdrawals, which may increase taxable income. This combination can create a situation where retirees feel like they have enough saved, but they're hesitant to withdraw as much as they want. Part 4. What the income ceiling looks like in real life. Here's a hypothetical example to illustrate how this works. Imagine a couple in their mid-60s, and they have $1.6 million saved in IRAs and 401ks. And they have $400,000 in their taxable brokerage accounts, and they have $150,000 in Roth accounts. In this case, they want to generate $150,000 per year of retirement income. Depending on their withdrawal mix, a portion of their Social Security may be taxed. Their taxable income could reach Medicare IRMAA thresholds. RMDs at age 73 may increase taxable income even further, and higher income may push them into higher tax brackets. These factors may not prevent them from taking the income they want, but they may influence how comfortable they feel taking it. Again, this example is hypothetical and for illustration only. Each household's tax situation varies. Part 5. How retirees may create more flexibility. While no strategy guarantees specific results, here are the approaches many high earners evaluate to help create more control over their retirement income. Strategy number 1. Use early retirement years for tax planning. Some retirees find that the years between retirement and age 73 provide the opportunity to shift a portion of their pre-tax savings into Roth accounts, spread taxable income across more years, or reduce the size of their future RMDs, and manage future Medicare brackets more intentionally. These strategies depend on income, tax bracket, and legislative rules, so they're best evaluated with professional guidance. Strategy number 2. Sequence withdrawals across account types. Different accounts are taxed differently. A balanced withdrawal approach may help some retirees maintain more flexibility. For example, taxable accounts for early years, pre-tax withdrawals in moderate income years, or Roth accounts for years when managing brackets or Medicare thresholds. This sequence can vary significantly by household and is not a one-size-fits-all. Strategy number 3. Delay Social Security for tax planning purposes. Some high earners delay Social Security not just for the higher benefit, but because delaying may create more low-income years for tax planning before RMDs begin. Again, this is not always the optimal choice. It really depends on life expectancy, income needs, and household financial structure. Strategy number 4. Periodically reevaluate the plan. Retirement income planning is not meant to be static. Tax laws change, markets change, income needs change, and healthcare needs change. High earners often revisit their plan annually to adjust for new tax brackets, income sources, and Medicare thresholds. Part 6. The bottom line. High earners sometimes experience a retirement income ceiling because their income interacts with tax laws, Medicare rules, and required minimum distributions in ways that limit how much flexibility they feel they have. But the ceiling is not fixed. It's simply a signal that income sources matter, timing matters, withdrawal order matters, tax planning matters, healthcare thresholds matter. With thoughtful planning, many retirees find ways to increase the flexibility, spread income more evenly, and reduce pressure on certain income thresholds. If you'd like to explore how your income ceiling might look and how your accounts could work together more efficiently, feel free to reach out.